Welcome to the Deep Dive. Today we're tackling Sapphire Foods India Limited, specifically their Q2 results for fiscal year 26. We're going to unpack what management called a reasonable quarter for KFC and Pizza Hut across India and Sri Lanka. Our mission really is to figure out what's driving growth, what's holding back profits, and what strategy Sapphire is actually testing on the ground.
Absolutely. And, we have to start with the big numbers, but also with a big caveat. Consolidated revenue hit about 7,401 million, which is up 7% year on year. Looks okay on the surface. But then you see the consolidated profit after tax, which was actually a loss of 128 million.
Right, and that loss immediately catches your eye. People expect growth and profit from QSRs.
Exactly. It looks like a problem. But the first thing we absolutely have to adjust for, and management kept hammering this point, is a timing issue. It's all about Navratri.
Okay, explain why the timing of one festival makes such a difference here.
Well, Navratri is generally a slower period for chains like KFC that rely heavily on non-Gudge sales, right? This year, the entire festival fell into Q2 last year. It was all in Q3. So if you just compare Q2 this year to Q2 last year, you're comparing a naturally slow period to one that wasn't affected by the festival at all. It skews everything. It's a critical context.
Got it. That makes sense. So keeping that Navratri shift in mind, let's dig into KFC India first. It's their biggest engine.
Right. So KFC India is showing some resilience, maybe more than the headline number suggests. The reported revenue growth was 7%. But if you adjust for that Navratri impact, like management suggested, they calculate the underlying growth was actually closer to 10%.
Okay, 10% adjusted growth sounds, well, pretty decent in this environment. But what about same-store sales growth? SSSG. That tells us how the existing stores are doing, doesn't it? What did that look like?
Yeah, SSG is where you see the pressure. It came in negative at -3% for the quarter. And that obviously raises concerns about the health of the existing base. And this is really important, they shared that before Navratri started, so up until September 21st, SSSG was basically flat. And even more tellingly, same-store transaction growth, SSTG, was actually positive.
So SSSG down 3%, but transactions, the number of people coming in, was actually up before the festival hit. What does that signal? Are people just buying the cheapest possible thing, like a value trap?
That's exactly what it points to. It confirms what management's been saying about consumer spending being really tight. The positive transaction growth means their value offers, their promotions are working. They're getting people in the door. But once they're inside, they're clearly trading down, buying less or cheaper items. The average check size is shrinking. Price sensitivity is super high.
So they're sacrificing margin per order just to keep people coming back. And it looks like they're doubling down on that extending the Epic Savers campaign into Q3. But surely they can't just run on low prices forever. Are they trying to tempt people with anything more premium?
Yeah, that's the balance they're trying to strike. Value keeps the traffic flowing, but innovation is supposed to lift the average spend. That's why they launched this KFC Feastival campaign. It's specifically built around some of their more well-known, slightly premium items, things like the chitza, the double down, the gold burger. They're trying to use these hero innovations to bring back some higher spending.
And alongside the menu strategy, I saw they're also pushing hard on the operational side, digital kiosks in their own app, trying to claw back some margin that way.
Absolutely. Efficiency and data are key here. Over half the stores now have these digital kiosks. Streamlines ordering, and critically, their own KFC app is apparently doing really well, better than the third-party delivery platforms in terms of performance. Controlling that digital channel gives them, better margin control and direct access to customer data, which is invaluable.
And despite all these headwinds, the weak consumer spending, the Navratri impact, they're still committed to opening 60 to 80 new KFCs a year. That suggests they're looking way beyond just this quarter, right?
Completely. It's a long-term bet. They believe the underlying demand for QSR in India is strong. It's just that wallets are tight right now. So they seem to be using this period to expand their footprint, maybe get better deals on real estate, positioning themselves for when spending eventually recovers.
Okay, so KFC, resilient but heavily reliant on value for now. Let's switch gears to Pizza Hut India. That seemed like a much, much tougher story this quarter.
Yeah, no way to sugarcoat that one. Pizza Hut India saw revenue drop by 6%, and SSG was even worse, down 8%. Restaurant-level EBITDA actually went negative, minus 1.8%. That's definitely a setback for a brand they've been trying hard to turn around nationally.
Which brings up the big question. Is the turnaround strategy itself flawed? Because management presented this really interesting counterpoint, didn't they? This regional proof point.
They did, and it's probably the most crucial insight from the whole earnings discussion. We need to talk about Tamil Nadu. Pizza Hut in Tamil Nadu is exclusively operated by Sapphire, and if you just look at that region, they reported double-digit revenue growth, and get this, a mid-teens delta in performance compared to the rest of India.
Mid-teens delta. Okay, break that down for us. What does that actually mean compared to the national -8% SSSG?
It means that performance in Tamil Nadu, both SSVG and transaction growth, was roughly 15 percentage points better than the national average. So instead of being down 8%, they were likely up somewhere in the low to mid single digits. Positive SSSG, positive transaction growth, it basically proves that something is working really well there, even within the same challenging macro environment.
Wow, okay. That is a huge difference. So what's the magic formula in Tamil Nadu? What are they doing differently?
Management laid out 3 core pillars. First, consistent, sustained investment in product innovation, not just random new pizzas. They mentioned things like the Juicelicious range, the Ultimate Cheese Pizza, the Cheesy Pocket, giving people genuinely new reasons to choose Pizza Hut.
Okay, innovation is one piece, but people need to know about it, right?
Exactly. Pillar number 2, higher spending on mass media advertising and awareness. They're actually investing significantly more in telling people about these new products and just keeping the Pizza Hut brand top of mind down there. It costs money, but it seems essential.
And the third part, it sounded like it was about using the physical restaurant space better.
Precisely. They call it a dine-in forward omni-channel restaurant strategy. They're recognizing that Pizza Hut's dine-in heritage can be an advantage. So they're actively pushing dine-in traffic. They mentioned specific value offers for dine-in, like buy one, get 3, or those unlimited Pizza Fridays, trying to shift the mix back towards people actually coming into the restaurants.
So the playbook works in Tamil Nadu. Innovate, advertise heavily, and leverage the dine-in experience. But the challenge is finding the money to do that advertising part nationwide when overall profitability is already under pressure. Which neatly brings us to Sri Lanka, where this playbook seems to be fully validated internationally.
Exactly. Sri Lanka is essentially the Tamil Nadu strategy scaled up and running successfully, despite facing its own arguably much tougher economic issues recently. The Sri Lanka business grew, as they put it, handsomely, 18% in local currency. Yeah. Look at the SSSG, positive 14%. Really strong.
14% SSSG in Sri Lanka after all the economic turmoil they've had. That's impressive. And margins held up too.
They did. Restaurant EBITDA in Sri Lanka was 15.4%. And this is the really interesting part for me. Remember back in Q1, they got hit with a huge 27% increase in the minimum wage, a massive cost shock. By Q2, they had completely mitigated that impact. Through price increases, yes, but also through internal restructuring and changing how they manage incentives.
That shows some serious operational muscle, doesn't it?
Oh.
Being able to absorb a 27% wage hike. It suggests that when the strategy is firing on all cylinders, innovation, awareness, dine-in focus, they can command pricing power and manage costs effectively.
Absolutely. It proves the model's resilience. And just as a quick note on their size, they mentioned hitting 997 restaurants overall by the end of September. And then right after the quarter ended, they opened their 1,000th restaurant, a KFC, fittingly enough, in Tamil Nadu. A nice little milestone.
Okay, let's touch quickly on operations again. The delivery mix, is everything shifting online?
It's shifting, but maybe not as dramatically as you'd think. For KFC, it's still majority dine-in takeaway, about 55% versus 45% delivery. Pizza Hut is closer to a 50-50 split. What's interesting is how delivery is growing. It's not just the big aggregators. Their own apps are performing well, apparently. And they're also pushing late night hours, sometimes till 5 a.m., which is almost entirely a delivery business.
Right. Okay, zooming back out to the macro view. How is management seeing the overall QSR market right now, and how's that influencing big decisions?
They're still pretty cautious. The message is consumer spending is tight and competition is fierce. It makes it really hard to just push through big price increases across the board to fight inflation.
In fact, they actually cut prices on some items recently, didn't they? Something about a GST change. Tell us about that.
Yeah, that was a clever little move. There was a small GST adjustment that gave them a tiny input cost benefit, like 0.5%. Now, spreading 0.5% across everything, nobody would notice. So instead, they took that small saving and concentrated it. They cut prices on their top 7 to 10 best-selling items by a much more noticeable 5% to 10% each. It makes the price cut feel material to the consumer, turning a tiny operational gain into a real marketing message. Very smart.
Turning pennies into perceived pounds. Clever. But the tough environment is having real consequences, especially for Pizza Hut expansion. They've basically hit the brakes there.
They have. The numbers were stark. Between January and September this year, net change in Pizza Hut stores was -1, basically flat or slightly shrinking. Management was very clear. Expansion decisions are driven by expected payback periods. And until Pizza Hut's overall same-store sales growth improves significantly, they're not going to pour capital into opening lots of new stores that might not hit their return targets. It's financial discipline kicking in.
Makes sense. Don't throw good money after bad, or at least wait until the model is proven profitable nationally before scaling it aggressively. And just quickly, there was a note about a board member resigning.
Yeah, just a standard governance item. Mr. Rohit Muthu, who is a non-executive nominee director from TR Capital, stepped down. The company made it clear it was simply because he left TR Capital, nothing to do with Sapphire's performance or strategy. Pretty routine.
Okay, so let's wrap this up. We've covered the Navratri audience, the KFC value focus, the crucial Pizza Hut split between Tamil Nadu and the rest of India. What's the central tension here? What's the main takeaway you want listeners to focus on from Sapphire's Q2?
I think the core tension is this. Sapphire has figured out a playbook that works for turning around Pizza Hut. They've proved it works in Tamil Nadu. They've proved a similar model works incredibly well in Sri Lanka. The problem isn't the strategy. The problem is the funding required to roll out the expensive parts of that strategy, especially the mass media advertising across all of India, particularly when overall consumer spending is weak and they need to be careful with cash. They know where they want to go, but paving that road nationwide is costly right now.
That's a great way to put it. It's a capital allocation challenge, not a strategic blind spot. Okay, and one final thought for you, our listener, to mull over after this deep dive. Considering Sapphire Foods managed to navigate and completely absorb that massive 27% minimum wage hike in Sri Lanka through sheer operational grit and smart strategy, what might that resilience tell us about their potential to manage costs and thrive in India if, and perhaps when, domestic consumer demand finally starts to pick up steam again? Something to think about.